Brian Lancaster is head of residential, commercial, and asset-backed securities at RBS. Great to have you here with us, Brian.
Thank you, Betty.
And first of all, just lay out for us, how distorted was it to have the Fed in this market?
Well, when we started out, mortgage rates were so high during the height of the crisis. So the Fed's buying was really critical. But one of the things that the residential services with the Fed buying mortgages, they really had nowhere else to go except the Fed. So that was a very key role in absorbing that.
Right, a key role, and we know that, as Mike was mentioning earlier, it's helped companies borrow very cheaply, and you've been able to borrow on your home if you're able to get a loan at a pretty good rate.
Yes.
So with the Fed stepping out, though, given that this distortion, why aren't the rates going to go higher because of this?
Well, I think there are a lot of private mortgage-backed securities investors that would like to get back into the market. The Fed recently has been buying about $10 billion a week. In an environment where all rates on all securities are pretty low, I think it's a pretty attractive investment right now. It's also one of the few investment alternatives to treasuries that you can get a AAA rating.
And have there been actual buyers of these MBSs that have stayed out because the Fed is in?
Oh, very much so. In fact, I was just in Asia a few months ago, visited maybe 30 clients, and all of them were saying, when is the Fed going to stop buying mortgage-backed securities? We'd like to buy it. In fact, the amount of demand there, I think, would be so great, which is why I think that you're going to have that limited spread widening.
And they've been out because they felt the rates were artificially low. They weren't going to make enough money on the spread,
Who
right?
wants to compete with the Fed?
Right, yeah, not a lot of people. They've got a good amount of cash there.
Exactly.
Okay, so is this going to also concur with a loosening of lending restrictions? Does that mean that homeowners don't have to worry as much then?
Well, I think that that's really critical. There's been a lot of focus on the Fed stopping the program. We think maybe rates will go up 15, 20 basis points, $50 or $60 a month. But what will be really key is for banks to open up their lending standards a bit more. That, I think, even if rates are a little...
And are you seeing that, though, or...?
We're starting to see that. It's encouraging. As the banks become more capitalized, I think you'll see that more and more. It's a slow process, though, and it will also be contingent on the housing market stabilizing.
Right. But that's a good point, because you always hear this caveat from the Fed, which is that, look, they're stepping out, but they could step back in.
Right, and that's really key. The Fed reserves the right to come back into the market should something else happen, and I think that provides an effective backstop to any significant widening in the market.
Okay, right. It's almost like a guarantee in a way, or some sort of insurance there if things go to pot. Okay,
exactly.
All right.
Hopefully not.
Hopefully not, but
I think we're beyond that at this stage.
Yeah, we are. Yeah, not the memories of a year and a half ago. Okay, right. Brian, thanks so much for joining us. Appreciate it. Brian Lancaster, head of residential, commercial, and asset-backed securities at RBS.